Howdy, Team 42. It's your skipper here, Darius Dale, coming to you from parts unknown. I'll be doing a decent amount of travel this summer, so bear with me, and I appreciate you guys for putting up with the changes in background and things of that nature. But at the end of the day, the process doesn't change, so we got a lot of information to get through today. So I appreciate having the opportunity to present our Around the Horn Weekly for Saturday, June 19th, 2021. And happy Juneteenth, obviously a special day for me, a special day for what we represent as a firm and what we all represent as part members of Team 42, which is diversity, inclusion, giving people opportunity, giving people chances to shine and succeed. And we're very grateful for the country taking a step forward in that regard. So without further delay, let's just get into the key takeaways of this week. Last week was arguably the most difficult week of the year for investors to risk manage with the surprise tightening of monetary policy out of the Federal Reserve, via its forward guidance function, i.e. the dot plot. The marginally hawkish pivot, it mostly impacted direct beneficiaries of the reflation trade, i.e., look at commodities, particularly the more speculative commodities that were sort of bid up on ropes, commodity producers, foreign currencies, things of that nature. And I would argue that the breaking down of market implied inflation expectations was the most clean-cut signal of the market regime phase transition to Goldilocks. As we discussed in Friday's leadoff morning note, deflation is no stranger to abruptly capturing the modal outcome title. So that, to me, this is why next week is such a pivotal week for risk assets to affirm Goldilocks. If they don't bounce from these oversold levels across a lot of equities and commodities, we're going to see some real damage this summer and some serious damage this summer. So obviously that would necessitate a full portfolio construction pivot to deflation, which obviously we've been tiptoeing into in terms of our fixed income and commodity exposures, but ultimately, we're going to have to, get rid of a lot of things on the equity and commodity side to make room for more fixed income, and things of that nature. And it might even be cash, who knows what the market signals will tell us. But for now, we don't want to speculate. We just want to continue to dispassionately execute the process. I'm a former football player. We have a saying on the gridiron: when you make a mistake, you get beat on the block, or you drop a touchdown pass or something like that. It's, hey, clap your hands, next play. Next play. There's always a next play. You can't spend any time, whether you took my advice or guidance and coming into last week and avoid it getting punched in the mouth by buying protection, shorting things, things of that nature, or you got punched in the mouth, irrespective of what happened to your portfolio last week. It's a new day. It's a new week. We have risk to manage on a forward-looking ex-ante basis. And that's what these presentations are designed to help you do. It's clap your hands, say next play, whether you had a great outing or a great terrible outing. It doesn't matter. Let's move on to the next play. So in terms of the next play, the only changes we're going to be implementing this week are reducing our exposure to reflation. Again, process driven. Goldilocks is now the modal outcome. So we're going to be selling all the commodity and currency exposures in particular that have broken down to neutral from a volatility adjusted momentum signal perspective. As an aside, nothing in the portfolio construction went bearish last week. So that to me is a signal in and of itself that we're not quite there. This is just, probably had a lot more to do with options expiry. I think we had a quadruple witching day on Friday. Not really big on that stuff in terms of, letting it drive the process, but I do think it obviously really mattered, particularly into the close on Friday when a lot of things just went vertically to the downside. So we'll see if those things bounce. But again, in terms of making the changes that we're going to make this week, we're going to be selling copper, selling ag, selling uranium, selling the Canadian dollar, and selling the Swiss franc. All those things have broken to neutral. Neutral again. When you're neutral from a volatility adjusted momentum signal perspective, it means that the trend in price is not being confirmed by the regime of volatility. Now, the trend could be lower, and you could be in a positive regime of volatility, or the trend in price, which obviously all these things were positive, and the volatilities for each of these assets are now in regimes that would necessitate a higher drawdown risk. So we don't want to expose ourselves to higher drawdown risk. Obviously, if they all transition to bearish, that would be the drawdown risk that the model would be predicting. So we don't want to overstay our welcome on the long side of crowded reflation trades. It's obviously been a great call since going back to my prior shop. Pivoted to put positive on commodities back in June. Pivoted to short dollar back in July. Obviously, the full blown reflation trade call in the beginning of November. A lot of it's been a hell of a run. For lack of a better phrase. So Now we're making some pivots. So in terms of what we're buying with that capital that we're freeing up here, we want to be, transitioning our exposures towards Goldilocks with an eye towards deflation. So in terms of the things that survived the back test, that look best on the back test and survived the market signaling process, that's defensives. DEF is the ticker for that. Israel, EIS is the ticker for that. Israel, in fact, from a grid perspective, looks really positive, going well into the summer. Very unlike most countries in the world, which are likely to see some negative macro regime inflections starting in August. Bitcoin. You say what you want about Bitcoin right now, but I bet you wish you were long Bitcoin instead of uranium and copper last week. And so obviously we're getting signals from the cryptocurrency market that we're not quite ready to go into a full-blown deflation. And if that's the case, and if Goldilocks is something that, I continue to believe has the ability to survive at least through the end of next month, if that's the case, Bitcoin's going to rip. Let's be clear about that. So we definitely want to be positioned for that if that is the case, which again, the market signaling process in aggregate continues to suggest that is a higher probability bet today. Again, today, it could change tomorrow, today, than betting on, full-blown deflation. Then we're transitioning to EM US dollar debt, which is EMB is the ticker there, and then extended duration treasury. So we'll go over all this in the presentation. Just wanted to sort of put that out there in the front of the deck to the extent that you guys are anticipating some changes. So on slide 4 here, looking at our prior portfolio construction. So came into the week 70% reflation, 30% deflation. Obviously, I took a lot of not flack, I would say, but certainly some very critical questions over the last few weeks in terms of putting the dollar in there on the long side. And guess what? 9.4% of the portfolio didn't go down last week, right? Like that's a win. Not only did it not go down, it actually ripped. And so that's something that we want to call out. This is why we do things the way we do things. It's not going to be, levered long one view. You got to have a thoughtful, balanced, constructed portfolio, particularly in and around market regime phase transitions. When you're at the beginning of a market regime phase transition, the whole pie is going to be one color because you have time to price in the new market regime. Right now, the whole pie shouldn't be one color. We're obviously in a very sort of critical threshold or critical juncture with respect to asset markets. Obviously, Goldilocks has overtaken reflation, both because Goldilocks is its probability has gone up, its score has gone up, but also because reflation has come down and deflation actually has come up quite a bit as well. So looking at slide 5 here, our posterior portfolio construction, we added defense instead of, so we took out copper, ag, we took out copper, ag, uranium, the Canadian dollar, and the Swiss franc. And then we added defense, DEF, Israel, EIS, Bitcoin, GBTC, EM dollar debt, EMB, and extended duration treasuries, EDV. So now this is our portfolio construction. So this is where we are now, and this is how we expect to stay again until that blue 30 there becomes a blue 100. I suspect it'll become a blue 100 sometime in early to mid-August. But if late July to early to mid-August is when I think that blue will be fully pivoting to that blue. But if it happens next week, it'll happen next week. Again, we have a process for making these changes. It's not about how we feel about a crazy OPEX Friday. It's not about how we feel about the Fed pivot. There's no feel in the process. It's all math. It's all data driven, and we know what to expect. We know I think we have as good as forecasts as anybody in the world on bottom up macro regime transitions, and I do believe we have certainly one of the best market regime observation models as well. And so we're going to rely on those tools rather than relying on my big gut feelings. I mean, no one needs to know what my gut feeling is on anything. And I appreciate that you guys ask for my insights, but the reality is we're not going to deviate from the process. So don't expect me to. On slide 6 here, just kind of highlighting that Goldilocks has become the market regime, has taken the title of modal outcome from a market regime probability perspective, i.e. the dark green line is now the highest line on the page. And again, as a point of process, we want to be orienting our investment activities in accordance with what the highest line on the page is. In accordance with what the highest line on the page is and what we think the next highest line on the page is going to be based on the outlook, based on the macro regime forecast. That's the only reason we do so much economic analysis, is because it helps us create a thoughtful high probability scenario for what the pending market regime or macro regimes are going to be, bottom up macro regimes are going to be. And that allows us to sort of anticipate how the market regime probabilities are going to evolve over time. But right now, we think the dark green line here on the chart on the right is what we want to be orienting most of our exposure to, with the eye towards the dark blue line at the bottom there, eventually becoming the line that's at the highest on the top of the page or on the top of the chart. So again, that could happen next week. Could happen in August. It could happen in December. We don't know. The answer, I stress this a lot. I do not know what's going to happen. I don't know anything about the future. I know a lot about the current state of affairs and the current probabilities about how the future might unfold. And to me, I think that's extremely valuable, is having the humility to know that we don't know. So that's just why we constantly are listening to the market through the lens of our global macro risk matrix, because we don't know, but we certainly think 42 core macro markets know a lot more than I ever will, sitting here in this hotel room. On slide 7, looking at the global grid map. So we have positive macroeconomic trends, and earnings momentum are likely to last through July. So, in terms of, getting, incremental feedback on, why you would stay long a equity or commodity that has a higher earnings volatility, higher beta, that's something that's positive at the margin. Now, again, all bets are off when you get into August. But again, I've talked about this ad nauseum in the June macro scouting report that, that's not necessarily a real nasty macro regime transition in terms of the speed of the decline in growth and inflation. I'm much more concerned about the market risk associated with the Fed pivot, associated with a potential disappointment on fiscal policy, and ultimately associated with potential disappointment in economic and earnings momentum in the back half of the year. But those, it's June. It's, we're not worried about that, because again, if we have if people sold the lows last Friday and we melt up over the next 6 weeks in Goldilocks, that to me will be something that people will, quite frankly, will lose a lot of points on their bench, sort of competing with that. So I think that's a legitimate risk. That's what the market is telling me is a legitimate risk. It's telling me that is a more legitimate risk right now than going full-blown deflation. So we're going to bet in accordance with the market. And if the market regime, the probabilities change again, we'll change. We'll be wrong on the view I just outlined, and we'll change, and we won't be as wrong as other people, because again, we have a process for changing that allows us to change much quicker than the average investor, right? You go back to, going back to slide 6 here, looking at slide 6, the market regime probabilities, I wrote about this on Friday's note. The deflation is no stranger to abruptly shooting to the top of the page. Like it almost always shoots to the top of the page really quickly. And then you go back and you look at the, the major market risk off events in the post-crisis era, in the QE era. We've seen deflation shoot up over the matter of 1 to 2 weeks really quickly, but it still got us out. The process still gets you out before the big drawdown. So let's go back to last spring or last winter. It goes from 7% to 30% in 1 week, and then it's the modal outcome as of January 30th. From January 30th to the lows of March 23rd, the market went down 32%. Even though you didn't nail the last week of January in this process, you definitely nailed the not getting nailed part of the 32% drawdown from that point. You go to 2018, Q4 18, I believe it became the modal outcome. It became the modal outcome in November 20th, but inflation became the modal outcome in late September. Inflation's also a risk-off regime in this framework. Inflation became the modal outcome in late September. Boom, 20% drawdown. Deflation became the modal outcome in, I want to say, December 14th of 2015. Boom, 15% drawdown after that. Again, these are all the drawdowns that occur after deflation or inflation become the modal outcome title. Take the modal outcome title from a probability perspective. 2011, June of 2011, before even the downgrade of the U.S. debt that catalyzed the August drawdown. In June, deflation becomes the modal outcome title. Boom, 20% drawdown. And then lastly, in the spring, summer of 2010, deflation took the modal outcome title in early May, and then boom, 15% drawdown. Again, you have time to get out when the blue line gets to the top of the page. The blue line doesn't get to the top of the page just to say hi. It's getting to the top of the page because it's saying, no, this is this is a really, really bad state for asset markets to be in. There's a lot of risk. Volatility is in a negative regime for a preponderance of assets, 42 different assets in the global macro risk matrix. This is a big deal. And so this is why we're not panicking right now, because we know we'll have time to get out if we need to get out. This is, again, so I didn't mean to go on a deep diatribe on that. So I appreciate you guys humoring me there. Looking at slide 8. So before we even get into the main meat of the process, I wanted to throw in some asset market, volatility adjusted momentum signals and probable ranges that, kind of help paint the tape, give you a better sense of why I believe what I believe about the next, 6 to 8 weeks of market action, as opposed to, I think a lot of investors, and maybe some of you, are starting to believe as it relates to deflation transitioning into full blown deflation next week. This is, so let's go through this. So on slide 8 here, tips break evens, they broke the bearish. So clearly inflation expectations have peaked. They're now bearish from a VAMS perspective, volatility adjusted momentum signal. I'll just use VAMS from short from now on, just to give myself a breather here. Deep value, which has obviously been perfectly correlated to inflation expectations, is still bullish. So even though inflation expectations have broken to bearish VAMS, deep value is still bullish. So that's a signal in of itself. Maybe it's about to break the bearish, but we'll see. IGOIS, so that's still bearish VAMS on slide 9 here. Slide 9, looking at high yield OAS as well, so bearish VAMS. So really not much movement in credit spreads, right? They're still making lower lows, lower highs. Bearish from a volatility adjusted momentum signal perspective. I promise I wouldn't say that, so I apologize. I'll put $1 in the kitty. Slide 10 here. So I have a firm belief as an investor. One of my investing sort of beliefs, that I've learned over the years from, thoughtful investors that I've interacted with and learned from, is liquidity dries up at the margins first. When you're going into a market event, you tend to see the suction of liquidity from the fringe markets, right? Like the smaller cap names, the more frontier markets in EM. And, that's something that we certainly saw last spring. The S&P 500 was making an all-time high in February, but, microcaps weren't, frontier markets weren't, they were already going down. So this is why I put this on the page here on slide 10, microcaps, IWC, frontier markets, they're both still bullish, right? We're about to go into deflation next week. Don't you think these things would have already been breaking down? I personally think so, man. And again, this is my own framework and thought process around thinking about that. But I think that we would see at least neutral VAMs from these exposures if the market regime is really truly about to break down into a deleterious way. And oh, by the way, the Fed is still buying $120 billion a month. Now I know the rhetorical policy pivot in the dot plot does change the liquidity profile of what the Fed's doing to asset markets in terms of its impact on the Eurodollar system, its impact on how hedge funds get financed and things of that nature. I'm not incredibly smart on that stuff, but I certainly do understand how the system works. So there was a tightening last week. We can definitely observe that. However, it didn't really impact things that you would expect to see crash on into a deflation regime. So this to me is something I wanted to highlight on slide 11. Again, even more fringe, Vietnam and Nigeria. Not to say that Vietnamese people or Nigerian people are fringe, just that these asset markets are incredibly fringe from the perspective of global asset allocators. Not a lot of people are long Vietnam. Not a lot of people are long Nigeria. These things are obviously incredibly illiquid in terms of the market exposures. And so the fact that they're both still bullish VAMs to me is a signal in and of itself in terms of maybe the market is about to transition to Goldilocks, and Goldilocks can hang out at the top of the probability chart there for a little while longer. So, who knows how much a little while or a lot of while is what it is. But again, in the absence of perfect information about the future, which we all are lacking, we're going to look to some of these ancillary tools in the toolkit to get us to the right answers. And then lastly, Bitcoin and Ethereum on slide 12. It's neutral VAMs and making higher lows, as is Ethereum. If we're about to go into full blown deflation, I would expect to see Bitcoin and Ethereum leading the market lower, because that's exactly what we saw, in many of the last drawdowns over the past 3 or 4 years. So, the fact that they're making higher lows now, obviously they've both crashed and the charts are gross, but the fact that they're making higher lows to me is something that I definitely wanted to call out, because the lack of lower lows to me is suggestive of, maybe a lot of what we saw in the U.S. equity market, in the commodities market, in the fixed income and currency markets last week had a lot to do with one, crowded positioning, in the Fed, a surprise. And then 2, you had a weird week with quadruple witching, which obviously had a massive impact on asset markets into the close on Friday. And so we don't want to overreact to something like that because it's not fundamental. It's not trending. On slide 13 here, just updating our grid asset market back test for the exposures that we did put in. So obviously you can see defense kind of right there in the middle of the chart there. It looks good. Israel right there at the bottom left. Not quite high on the chart, but again, you're going back to the grid outlook there. Israel's likely to be in Goldilocks for the next several months. And that's a very big divergence relative to where the rest of the world is. So I'm comfortable with that exposure there, particularly given that it's, closer to the left side of the chart there in terms of mean volatility and covariance. On slide 14, Bitcoin, I mean, you look at the back test, so it's like, this is what you want to be long. And this is what the market is telling you to be long from that perspective. And then lastly, looking at EDV and EMB, from the perspective of that, the fixed income back test as well. And again, just how to read these charts. On the x-axis, we're ranking each of these exposures on a volatility, we're ranking volatility, ranking covariance, and averaging those rankings. And then we're ranking on the y-axis, we're ranking the annualized expected return and the percent positive ratio on the y-axis. So you're kind of getting a sense of risk on the x-axis and a sense of reward on the y-axis. So obviously, if you're trying to be long of exposures, you want to be selecting things closest to the top left of the chart as you possibly can. And to the extent you want to short things, let's say you believe, going back to slide 13, actually, let's say you have a belief that we're about to go in deflation next week and you don't want to wait on the signal. That's totally fine with me. The whole reason our process is super transparent is because I want you to front run. I want to empower you with the tools and the analysis to do this yourself. You don't, to beat me at the game. I don't care. This is not a competition. We're all on the same team here. So at the end of the day, if you really want to start to put short exposures on, looking at slide 13 again, going back a slide, you want to be thinking about things at the bottom left, the bottom right, high risk, high volatility, high covariance, low expected returns, low percent positive ratios. So SPHB, if looking at the chart on the left, sticks out like a sore thumb. Unfortunately, IYT transport is something that we're obviously long. It's still bullish, and we still expect it to recover if we do go into a extended Goldilocks period. But if it doesn't recover and we don't go into Goldilocks, then we'll have to sell that. It is what it is. The market doesn't owe us returns. We're just trying to, hit the singles and doubles that the market is giving us. Jumping ahead to slide 15 again. Slide 15. So we're dumping everything into the chart on the left there. That's the global macro asset market backtest summary. That's everything. When you're looking at it on a risk reward ratio at the x-axis, and then you look at it on an annualized expected return on the y-axis, and then we Winsorize that sample. We shrink it so that you can see the dots better on the chart on the right. So these are the exposures we want to be picking from when we get to the where we are on slide 16. This is why defense is in. This is why Israel's in there. We're not necessarily why Israel's in there. Israel's in there more fundamentally. The fundamental signal is much better than the back test. And then Bitcoin, the emerging market bonds, dollar debt rather, and then extended duration treasuries. When you look at Bitcoin, so in terms of the actual weightings, I got some questions on that, or I explained that in depth in the June scouting report. So I'm not going to waste too much time talking about it today. But in terms of the reason Bitcoin, because I know you're going to look at that 10.5% of Bitcoin and say, what is this guy smoking? He's smoking peyote. No, I'm not smoking peyote. This is what the model is telling me. And so the risk, so these percentages are based on the risk budget associated with the equity and commodity exposure and the fixed income and FX exposures that you should have as a part of, in terms of the portfolio construction process. The starting point is the dynamic asset allocation framework, which we obviously go over in detail in the scouting report. However, so when you get to that 49% equity and commodities, that's your total amount of risk you can allocate to equity and commodities. Well, Bitcoin, from a risk budget perspective, deserves 10.5% of that, or it deserves, or 1,550 basis points of that, because of its low volatility and low covariance. Again, the risk budgets are determined by the volatility and covariance of the asset according to the styles of grid asset market backtest that we're selecting. So deflation, a growth slowdown and a zero sigma delta. I actually changed the inflation deceleration to a -2 sigma delta because I wanted the back test to mimic the breakdown in inflation expectations. We're not going to see an inflation deceleration that swiftly, but I certainly want to mimic what the market is suggesting at the current juncture. So -2 sigma delta on inflation deceleration, nothing on policy rate, balance sheet tightening. In terms of the central bank balance sheet, fiscal policy tightening, we're still in this void of tighter fiscal policy for a couple of quarters, and then we have the rest of the world in deflation as well. So, in terms of orchestrating those back tests, this is how we're coming up with the risk budgets that get you to these positions. Now, again, you clearly don't have to follow along with any of this, let alone the weights. I'm just telling you this is what the math and the history is telling you how Bitcoin it fits in with respect to all the rest of these securities. It's not about Bitcoin's upside potential or percent positive ratio. It's purely based on its volatility and covariance. And when you're talking about, potentially going into a negative market regime transition, you want low volatility and low covariance, right? Like that's the whole point. So again, that's how we get to that. Again, you obviously don't have to follow along. I just wanted to call that out because I know I'm going to get questions on that. So getting into the meat of the presentation, looking at positioning, we have a positive medium-term signal for our long bond positions on TLT and EDV in terms of the 3-month delta of the long bond net futures and options, net speculative futures and options positioning. On slide 18, looking at crowding and dispersion through the lens of our IVOL, RVOL percentage spread relationship, and then looking at dispersion through the lens of the month-on-month Sharpe ratio. So, I spent about 10 minutes talking about this last week, and the key conclusion was, look, this market is very dangerous. Like everyone got squeezed out of their shorts. People are unwilling to pay for protection. So I was very clear and said, look, I think the market's going to get punched in the mouth next week. And if you took that advice and bought puts or shorted a bunch of stuff, you had a good week. I had a good week. Yeah, not a great week. No, sorry. I had a not good week, but I had a much better week than I could have had I not done the analysis. Had I not, acknowledged the fact that, the market was in a very, very risky state. Again, I was wrong on the view. A lot of people were wrong on the view that the Fed was going to pivot. I didn't think the Fed was going to make that, dot plot, I didn't think Jay Powell was going to say what he said in terms of affirming the upward hawkish revisions of the dot plot, things of that nature. So dead wrong on that, but right on the market view. And the reason we're right on the market view is because it's all about the setup heading into the week. It's about the setup. The setup was very negative. The people were unwilling to pay for protection. People were very clearly got squeezed out of all their shorts. So in terms of looking at it this week, it's a much better setup in terms of, on a go forward basis. We've seen the correction, in inflation trades. You now have the meaningful implied volatility premiums and things like materials, industrials, financials, things of that nature, oil, for instance. You're looking at the chart on the right. You look at the bottom. So this is 50 U.S. equity sectors and style factors, from a Sharpe, analyzing them on a month-on-month Sharpe ratio basis. I explained, kind of why we look at it that way last week and in our YouTube series. So you can check that out. So I don't want to beat that dead horse, but you look at the bottom now, like it very quickly went to get me out of reflation, right? Like it's like materials, financials, value, industrials, mid value. Like the market is very quickly went to, something that looks like the post-crisis strong dollar playbook where investors got paid to be overweight the digital economy in lieu of the real economy. Again, this is not the forum for that discussion, in my opinion, but I'm not saying whether this is right or wrong. However, if we go into Goldilocks, you're going to see a lot of the stuff at the bottom really start to recover and bounce off those lows. Now, if they make new highs, I think that's a different discussion. But certainly from these oversold levels from a lot of these different exposures, I think it's very likely that, this was an overreaction, not only to the Fed, but also to quadruple witching. So we'll see. Again, our positions are our positions. We put our stake in the ground beforehand. It's very clear what we like, very clear what we don't like. I'm not going to come talk to you next week about something I didn't talk to you about this week and say I nailed it. That's not what we're doing here. What we're trying to do here is be transparent and accountable in a way that I think is quite frankly, I think it's a breath of fresh air. You see me every day, you see me every week, you see me every month. I'm not going anywhere. So let's keep it moving. On slide 19, S&P 500 is bullish, VAMS and oversold. So this would be a great spot to be heading into the week, adding risk, right? I think most people can kind of feel that, but certainly This is, it's pretty clear on the chart. CRB index, commodities, oversold, but it's now neutral VAMS. And if you notice the chart on the right, the chart on the bottom there, the red dotted line, boom, so the VAMS is pulling, now that it's no longer bullish, it's skewing the probable range. It's making it much tighter because the upward skew in the upper boundary of the probable range no longer exists. And so that, we talk about that every week in terms of how the process works, how those two models are intricately linked from a rescaled range perspective. On slide 20, looking at the US dollar, it's overbought, it's grossly overbought, but it's now neutral VAM. So that compresses the lower boundary of the probable range, which means it's unlikely we see new lows in the dollar from here. The dollar's put in its low. Now, it could still make a lower high here and go back down towards those lows, but it's very unlikely that we see the dollar break down from here. So that's something to call out. And obviously the move on the short end of the curve is really driving that. And then the 10-year on slide 20, same slide. It's still bearish VAMS. It went bearish VAMS not last week, but a week before. We've been talking about this for a few weeks now in terms of the cascading sequence of things that have transitioned, that have been negative reflation signals. And there have been positive signals towards both Goldilocks and deflation. 30-year broke down, the 10-year TIPS yield broke down, the 10-year yield broke down, 10-year JGB yield broke down, so it was a bunch of stuff over the past few weeks that had occurred. And when you amalgamated them and you added them all up, it's pretty clear that, hey, we were going to have a, big breakout in bonds and then long into the curve. And quite frankly, I'm shocked to see a major global macro hedge fund blowing up still on things that are imminently observable to somebody sitting in a room with Excel. So, certainly not sorry, I apologize if that sounds like schadenfreude. It's not. Obviously, it is what it is. But I think the process is working. Is the process perfect? Absolutely not. No, I don't expect to be perfect. I hope you guys don't expect perfection here, but you can always expect accountability. You can always expect me to be outworking our competition, and you can always expect, the honesty and the integrity that you come to expect from me and you come to expect from my brand. So, I'll leave it at that. On slide 21, so let's getting into the portfolio construction. Defensives, they're bullish VAMs and oversold. Denmark's bullish VAMs and oversold. On slide 22, Israel's bullish VAMs, it's nearing oversold, not quite. Sweden here is bullish VAMs and oversold. So a lot of things kind of look the same, right? They're bullish VAMs, they're oversold. So you would expect to bounce next week. You would expect, if Goldilocks is truly about to, if deflation is about to, let me say this again. Let me say this a better way. If deflation was about to truly break out as the market regime title, as the modal outcome from a market regime title perspective, modal outcome title perspective, then all this stuff's going to go straight down and it'll happen in a heartbeat. It's not going to kind of, let me take a few weeks to figure out if I want to go to deflation. No, that's not how it works. Markets take the escalators up and they take the window down. So, you look at the chart of Sweden right there. It looks like it wants to take the window down, but again, it could also just be a correction. Don't overreact to corrections. The time to react to the potential correction was last week when we said buy protection, don't get punched in the mouth. This is not the time to overreact. It's the time to dispassionately calm down, breathe, execute the process. Keep it moving. On slide 23, Mexico's bullish VAMs and it's oversold. So is Bitcoin's neutral VAMs and it's oversold. So again, I like things that look like they're uncorrelated with everything else, right? That's what I want to be doing here. And certainly stock to flow will tell you Bitcoin's going to be at 100,000 by the end of the year. So maybe this was the correction that people needed to, maybe that was a big major correction to shake all the, the weak hands out, the people who don't truly understand the long-term dynamics of Bitcoin. I'm not a Bitcoiner, I am a Bitcoiner. I guess I believe in the tool and the liberation that it provides to people all over the world in terms of their currencies. Think about places like Venezuela and things of that nature. But I'm not an evangelicalist. Bitcoin is either in the portfolio or it's not in the portfolio. And if it's in the portfolio, it's in there for a reason, based on the grid outlook, based on the market regime and the macro regime information that we're providing. On slide 24, mid caps and transports, same thing, both bullish and oversold. I kind of called out transports, was it a week ago or last week or 2 weeks ago? It's like, I don't like this chart, but I'm going to stick with it because again, if we're about to go into Goldilocks, this chart's going to recover. So let's, asset markets correct, particularly in around surprise changes to policy, crazy things like quadruple witching, all this stuff. Like, if quadruple witching is about to start a market crash, then we need to close the options market. That's a joke, but I think you get where I'm going with that. On slide 25, silver, crude oil are both still bullish and oversold. So I would expect a pretty material bounce in silver. I mean, it's grossly oversold. It's very, exhausted to the downside in that regard. So, I just, if we're, again, frontier markets in Venezuela or not Venezuela, Vietnam, frontier markets, microcaps, these things would be crashing if we're about to truly go into a deleterious market regime transition. So I just, again, when I look at a chart of silver, I know it looks scary. I know it feels scary if you're long silver, but again, maybe this was just, it took 2 days to ring out what become, speculative positioning on the long side of precious metals. On slide 26, energy, real estate, both bullish still and both oversold. So you know what to do with that. BDCs and leveraged loans, the same thing, both bullish VAMS and oversold. So you got a lot of oversold signals, but obviously, if you notice, I keep saying bullish VAMS, bullish VAMS, bullish VAMS, bullish VAMS. Things are still bullish. Like, I know last week felt very sticky and gross, but the signal, like, it's to be bullish VAMS, you have to have positive trending price momentum, and you have to have volatility in a regime that is historically perpetuated. You have to have volatility on the side of the distribution that is historically perpetuated lower drawdown risk. And for all these assets, you're consistently, with the exception of Bitcoin, they're all bullish. And then looking at dollar debt here on slide 28 and extended duration treasuries, both still bullish. They're not actionable though. They bounced off their lows late last week, so kind of in the middle of their probable ranges. Looking at on slide 29, gold in the treasury belly, bullish VAMS, gold's bullish VAMS, kind of looks like the chart of silver. So, a lot of people got paid on the long side of gold for the last few months. A lot of those people are now underwater, including us. And but again, we believe in the exposure. We certainly don't think that, real interest rates are poised to make this material breakout in the context of a deflationary, not deflationary, sorry, a deflation macro regime which we're headed into. Again, when I say deflation from a macro regime perspective, I don't mean negative year-over-year CPI or PPI. What I mean is that growth and inflation are trending lower at the same time. So you're not going to see a big breakout in interest rates in that regard. It's unlikely. You could. It's unlikely. And then lastly, on slide 30, 20-year treasury bonds, TLT, those are neutral. No, they're bullish VAMS. Sorry, my apologies. 20-year treasury bonds, those are bullish VAMS, but so they obviously broke out when bond yields broke down a couple of weeks ago on our signal. And then the U.S. dollar, it's neutral VAMS now. That's what I meant to say. The dollar is now broken out to neutral VAMS, but it's overbought, grossly overbought. So we would expect another lower high in the dollar chart there, but maybe it doesn't make a new low. It's the Canadian dollar is having a hard time breaking out. It had a hard time breaking 120. Euro had a hard time breaking 123. There's just a ton of resistance in the currency market from that perspective. And so that's why the dollar chart wouldn't make new lows. Now we know, but certainly from here, again, we would expect to fade the dollar here because we expect Goldilocks to be the dominant market regime for at least through, the end of next month. And if we're wrong on that, just like I said at the beginning of the presentation and throughout the presentation, we'll know in a hurry. So with that, Darius Dell here, your skipper, with a very exciting Around the Horn weekly update. I'm excited for next week. I'm excited to be rowing this Team 42 boat with you guys. So with that, thanks for participating. We'll see you next week.